resume. So you completed your CA in 1984. You worked as a corporate account manager, deputy manager, director of finance and operations, business manager, chief operating officer, and then you are also a visiting professor at St. Joseph Institute of Management, Indian Academy Degree College, Bangalore, Ramaiah College of Arts and Science. And then there's a turning point that, in spite of this amazing resume, till age 50, you say ki you have not saved anything. And then you achieved financial freedom in 7 years. So before we talk about those 7 years, I would like to know, like, so, like, what are the mistakes that you did? Because you were not saving anything, like, till age 50. What happened?
Correct. Right from the beginning of my career, I had an
Right.
above average salary,
Okay.
but above average expenditure also.
Okay.
As the salary increased without our knowledge, the social status symbols also increased, and the expenditure has kept pace with the income.
Any specific example you can give about status thing where you spend a lot?
Maintaining two cars with drivers,
Okay.
living in a very big house,
Okay.
going to restaurants often,
Okay.
spoiling your health as well. So, nobody taught me how to save and invest. Even my CA degree did not teach me
Yeah.
how to make money for myself. It taught me how to make money for others. Up to the age of 50, I did not have much savings, maybe 4 to 5 lakhs in the bank, which amounts to nothing in those,
Okay.
even in those days. The first mistake I did was not to take life insurance on my life. Because if something has happened between my 28th year in which I got married and
Right.
50th year, my wife and children would be left with nothing.
Right.
That was the first mistake that I did. The second mistake is not to create a contingency fund, because anything might happen which can hamper your job. Because I was always working with private companies, and that to sick companies.
Right.
Anytime my income might stop. So there is no contingency fund I have created, which means God has been very kind not to create any kind of contingency or emergency in my
Right.
life. The third is not investing, not saving and investing. These are the three mistakes that everybody does who does not know how to save and invest or how to create wealth for ourselves. Usually the courses in universities and colleges, they teach us one thing, how to make money for others.
Right.
They doesn't teach us how to make money for ourselves.
Exactly.
The mistakes that I did not do, I did well, was taking a health insurance policy.
Okay.
I took a health insurance policy very early in my age for me and my family, because the time I took was the time when the family floater was introduced. Before that, we used to insure each member of the family separately.
Right.
So I took use of the family floater and insured my wife and my children.
People who are, sir, actually not aware of this concept, can you please simplify for them
The health insurance.
the floater part?
Family floater means the whole family is covered under one policy, right? Before the family floater came, if there are 4 members, we have to take out 4 individual policies.
Okay.
So I was taking an evening walk with my friend in my hometown, which is near Coimbatore.
Right, sir.
He suddenly asked me, Lakshmi, what would your wife and children get if you die tomorrow? I was quite startled and surprised.
Right.
I couldn't sleep that night. So the next day, what I did is I went to the nearest insurance advisor.
Okay.
Usually, insurance advisor chase you, right?
Right.
Please take policy.
Yeah,
But
they
I
keep
chased
calling.
an insurance advisor to and say, give me policy. I will write out the check right now.
So what was the premium that you were paying?
Premium was about 1,50,000 per annum.
Okay.
Because I took it at
Age 50.
age 50.
Yeah.
Had I taken it at 28, the premium would have been 8,000 per annum. So I answered my Friends question what my wife and children get if I die that day. That is 1 crore. I analyzed all the asset classes that is available in India that time.
Right.
So I found in my research that only investment in mutual funds, equity mutual funds, and equities will create wealth fastest. So I did not have much time. I was already 50. So
Right.
I had to create a retirement corpus and a higher education fees for my children. So those two things were the only thing I needed to provide at that point of time.
Okay.
So the first thing I did was to calculate how much my retirement corpus.
So what was that?
That is in crores.
Okay.
It is not in lakhs. It
Yeah.
will be in excess of 5 crores.
So how to actually, the most important thing, how to calculate the retirement corpus?
Okay, I will give you a ballpark method. We do it by extensive mathematical calculation,
Okay.
but the ballpark method, supposing you are spending 1 lakh per month today, your retirement is 20 years away.
Right.
So at the end of 20 years, you may require 4 lakhs per month. That is 48 lakhs. Okay, 48 lakhs per annum. Divide 48 lakhs divided by 5.56%. That would give you the retirement amount.
So if we quantify this number, so let's say the 10 lakh worth of value that we are getting today, the bucket of articles that we are able to buy worth 10 lakh today, the same article we have to spend like close to 25 lakh after 10 years.
Correct. 27.5, 2.75%.
Okay. So 27.5 lakh rupees after 10 years.
So I immediately, for the next 7 years, every month, I used to invest 2.5 lakhs per month.
Okay.
My salary at that time was very high.
Okay.
So because I started late, I had to go with a higher corpus. So 2.5 lakhs per month for every month without fail. So that is the first debit that will go out of my bank account.
Understood. So where you were investing this amount?
I was investing in pure equities and equity mutual funds.
Okay. So 100% equity.
100%. That is another mistake I did. What I did is I put the entire amount in equities and equity mutual funds because my research showed that these are the high return yielding instruments. In 2008, the Great Depression occurred globally. Indian markets went down by 50-60%. My own portfolio went down by 80%.
So you were not scared at that time?
I was not scared at that time because I knew the nature of stock markets
Okay.
and how stock markets behave.
Because something similar is happening right now also.
Yeah, correct. It is similarly something happening. There were two things I did smartly. I did not invest lump sum. I invested in monthly SIPs. So when you invest in equities and equity mutual fund in SIPs,
Right.
what happens if the stock market goes down? You get more shares or more number of units of mutual fund.
Right.
As long as you don't withdraw until the market is up. In 2012, when I checked my portfolio, it was more than quadrupled.
Wow.
So that is the power of patience.
Right.
And I could, whatever bonus incentive I could get, I invested everything in equities and equity mutual fund.
So when you achieved financial freedom, what you did? So you took the retirement.
Yeah, I immediately went to my boss and said, I fire you. That's dramatic, isn't it? And my boss was shocked and surprised because I was doing well in the company. And suddenly I told him I want to resign. So I told him that I got the retirement corpus and continuing in the employment is an unnecessary stress that I would like to avoid at this point of time. And of course, I ensured a smooth transition and I left.
So can you take us through like what a viewer should do? Like what are the steps they should do?
I'll just demonstrate one example.
Okay.
I'll share the screen.
Okay.
See, a person saving 30,000
Right.
Okay. This is a context. And the 20 years he has been doing SIP. If he has invested in Kotak Mahindra Bank, he would have got 24 crores at the end of 20 years. HDFC Limited has returned 13.71 crores. ICICI is 6.67, Axis is 12.15, IndusInd Bank is 11.4.
So my question to you is like, so how would you identify, like, if we
No,
go,
correct. It is very difficult to identify Kotak Mahindra Bank will give the maximum returns. So what we do is we invest in the bouquet of the leading banks. 20 years before, these were the leading banks. So if you have invested equally, you would have created 12.48 crores. CAGR is 21.45. These are actual figures. I have put the share price as on 1/4 and I have calculated the CAGR with a formula. These are actual figures. Now take financial services. If you invested the same amount in Bajaj Finance, 348.28 crores is what you would have got. 32,000 rupees SIP in Bajaj Finance. Still, we can say in Bajaj Finance, you cannot say that it will give the maximum returns, right? So you invest in a bouquet of NBFCs. You would have created a wealth of 101.46 crores with 24.5 as a CAGR, right? So now FMCG companies, it would have created 15 crores. Now let us see the mutual funds returns at a glance. I have taken all the mutual funds that were available 20 years ago. So large caps, if you see, average it has returned 17%. Large and mid caps 17.57%. Mid cap is 18.39. Flexi cap is 18.19. Small cap is 17.75. Value oriented is 19.41%. ELSS, this is saving, tax saving, it is 17.06. So the mutual fund over 20 and 15 years have generated a minimum of 17% CAGR returns. Now, if you have invested in a mix of large cap, large and mid cap, flexi cap, value oriented and ELSS, your average return is between, if you see this various funds, it is between, the lowest return is 16.19%. Yet many of us keep it in fixed deposit saying that it is safe.
right.
Actually, fixed deposits is not safe. It is the most insecure instrument because it doesn't beat inflation. The first step is to take pure life term insurance. What is pure term insurance policy in life insurance? That is, you pay a small premium for a higher coverage. Something happens to you, your family will be paid the insured amount. If nothing happens to you, the money goes to the insurance company. You don't get anything at the end of 10 years, 15 years or 20 years.
Okay, so the first step is to calculate the insurance.
Correct. Calculate the insurance amount. This is 15 to 20 times your annual salary.
Okay.
People take 5 lakhs, 10 lakhs. It doesn't have any meaning at all. Because if a family gets 10 lakhs and even if they get 10%, they will get 1 lakh per annum. That is 8,000 rupees per month.
Right.
It will not cover even 2-3 days expense.
So
If
let's
it
say
is one.
my monthly salary is 1 lakh.
Then your annual salary is 12 lakhs.
Right.
Then into 15 is 1.8 crores minimum
Right.
to 2.4 crores.
Right.
That is how we should calculate. I want to demonstrate this, if you don't mind.
Yes, sir.
First step, one in wealth creation is sort your insurance. One is life insurance.
Understood.
Pure term insurance is the only insurance you require. All else is noise. Take 15 times your annual salary until the pure term insurance reaches 1 to 3 crores. Take up to 20 years only. Why I am saying don't take for life? Take up to 20 years only. Because in 20 years, you will have an investment corpus which is bigger than your term insurance.
Right.
The second is health insurance. Many people say my claim is partially disallowed or completely rejected. It is their own fault. Partially disallowed means there's a cap on room accommodation, there's a cap on daycare treatment, there's a cap on domiciliary hospitalization, there's a cap on donor expenses. All these should be up to sum insured. There should not be cap or limits or sublimits for each element of claim that you should insure. So you should select such a policy that allows everything up to sum insured. The second shock that people get when disallowing their claim is on consumables. Consumables can form a major part of your medical expenses, especially when you are operated. Many policies do not cover consumables. The third one is personal accident insurance. Everybody knows about life insurance. Everybody knows about health insurance. Okay, if you meet with a personal accident and you die, term insurance will pay your wife. But if you meet with an accident and survive and hospitalized for a long time, neither your term insurance nor your health insurance will cover. So you should take at least 1 crore to 3 crores of personal accident insurance. Of course, vehicle insurance and property insurance. Most people do not cover vehicle insurance for flood. But in Bangalore, often heavy rains bring heavy amount of waterfall into the parking lots of apartments. And cars, I have seen cars and motorbikes floating. My son's motorbike is one of the items which was floating after heavy rain. He didn't cover for flood, so his Himalayan bike was a total write-off. The second aspect is emergency fund planning. Features of debt securities is it is easily cashable, no loss of principal. So first is sort your insurances. Second, keep 12 months monthly income before tax in emergency fund so that you can draw from it when an emergency occurs. Then you have to put your financial goal planning. So most of the people have got their own education. They try to, after getting employed, they try to do some IIM or ISB courses, which are having fees from 20 to 50 lakhs.
Right.
Car, everyone would like to aspire for a car. Marriage, some people take loans for their marriage also. They also require cash flow for that. House, everybody wants a house, their own house. Children's education after getting married. Children's marriage after 20 years. And they have to plan for retirement. So they have to specify how much money they are going to spend on each of these items. This you would be able to estimate how many crores you would require for this life.
Do we have a multiple of something? Let's say if I add all the 8 numbers and it is around 8 to 5 CR.
Yeah. It also depends, 10 years, 15 years or 20 years.
Yeah, so 5 CR as of now, let's say. And then I have to inflation adjusted to get the amount individually for each of these segments.
Okay, let me calculate and see. So it is 5 crores and we say that rate is 7% inflation. NPAD is 20. So 5 crores will become 20 crores approximately. That is 4 times in 20 years. Then in 10 years, it will become 2 times. In 15 years, it will become 2.5 times. A little more than two, is between
So
2.5
just to
to 3.
summarize, let's say if I need 5 CR today,
Correct.
after 10 years it would be 10 CR.
After 10 years, it will be 10 CR, correct.
Yes. So now I have to just reverse calculate and see how much amount of SIP I have to do right now so that I get to that amount after 10
Yes.
years.
Correct. After that, you have to select the mutual funds and equities in which you want to invest. Initially, if you don't have a corpus or if you don't have a large saving, you should go for equity mutual funds. And this step is after creating the emergency fund parked in debt mutual funds. That's it. So they should diligently and in a very disciplined way, without even missing one single installment, they have to do the SIPs.
So what is this taxation planning?
Taxation planning. There are two regimes, old regime or new regime. In new regime, not much deduction, but tax is on a lower level and the income tax slabs are at a higher level. Now, one is actually confronted with the question whether old regime or new tax regime. A person getting about 18 lakhs and above can choose old regime, because in old regime there are unlimited allowances which are tax free. I'll tell you one example. One of my clients, he enrolled in a course in IIM Bangalore. The fees was 10 lakhs. So he requested his HR to incorporate learning and development allowance at 10 lakhs. So whatever fees he has paid under old tax regime, it is tax free. When you are filing the tax online, they give calculator, new regime calculator, old tax regime calculator. You press detail, old regime and new regime, put all your salary particulars. It will calculate the exact tax and show, and you can choose whichever is good.
So like how you actually select a mutual fund?
It is based on various parameters.
Okay.
So equity mutual funds is over a long period of time. So we calculate the 10-year rolling returns,
Okay.
15-year rolling returns, and 20-year rolling returns, and see which funds gives the best. But this is not all. We want a fund which gives consistent returns,
Right.
right? It's not that a fund gives 50% this year and 10% next year. That is actually calculated by standard deviation.
Okay.
Okay.
And these
So,
numbers are available on internet and every site.
yes, it is available in websites like Value Research Online,
Okay.
Morningstar.in. They give very good parameters of returns and risk. So the second is, what is the returns per rupee of risk taken? This is actually measured by two ratios called Sharpe ratio and Sortino. Okay. So Sortino only takes into account the downside risk, that is the losses, whereas Sharpe actually averages both upside and downside. So Sortino is a more sharp value. And there is one more ratio called alpha. So how much excess return they have generated over the indices. Supposing I am evaluating large cap, the applicable index is Nifty 50.
Right.
So over Nifty 50 returns, how much they have given, that is measured by alpha. And beta. Beta is market, it measures market volatility. These are the four things I use. Based on that, I rank.
Okay.
So whoever has scored the highest rank, the top 5 I select. And then I go to the rolling returns. First is risk factor. The second is returns. Then I compare the 5, 10, 50, 20 years rolling returns.
Okay.
And again rank them, rank the 5 as what is the best fund.
Understood. So let me summarize what we have learned till now. So how to get financial freedom with jobs. So like think the first step is to get the term insurance, which is mostly like 15 times of salary. The second is to get the health insurance. Third is the accident insurance, so that if you met an accident and if you do not die and if you are in hospital, so that's why this particular insurance is important. Then you take a normal insurance, which typically everyone takes for your car and everything. But do cover the flood insurance, etc. We can top up these insurances as well. So the fifth was to get the emergency fund. The sixth is to actually calculate the number. So it is the sixth step where we are actually planning what is the amount that we need. So what is the amount do we need right now? And then we can extrapolate it to 5 to 10 years when this amount will be needed. And the seventh step would be to select the particular mutual fund based on 3 to 4 numbers that we discussed. One is like the consistent returns, 10 to 15 years rolling returns, standard deviation, and sharp factor. And once we have selected our 3 to 4 mutual funds, we can sit and relax and just put the money. And whenever we are getting the bonuses and everything or segment, we can increase the SIP and put all that money in this particular thing.
Yeah. We have to review the portfolio every 6 months. That is
Right.
very important.
Right. So
You
we
just
can do the
cannot
course correction.
blindly put and relax, because
Yeah.
a fund manager can leave the fund.
Right.
A fund management can change.
Right.
So these are the changes that one should track.
Great.
If the fund manager does not change, yes, probably his performance will continue because his style and his thinking is the same. But once the fund manager has changed,
Right.
then there is no guarantee that the new fund manager will have the same thinking. So you have to be more careful in reviewing.
Thank you so much, sir, for coming to the podcast. I think